We are live at Live Oak Facilities with the managing director of the Veterinary Dental Pharmacy. Most everything that relates to Live Oak. Brandy, thanks for taking some time.
One millionth of it, yes.
Wow,
Mhm,
quite the
thank you.
resume. So in the lending environment we're in today,
Mhm.
because it feels like 9 out of 10 conversations that I'm having
Yes.
is, revenue slowing down across industry, staffing concerns.
Mhm.
Is it the right time to grow, build, secure financing with a lender like yourself?
I think it is very case specific.
Mm.
I do not think everyone should be growing and expanding at this time. However, practices that are doing very well and have the room to grow should be considering it because you should act when others are scared. And this is a time that a lot of people are afraid to make moves, and that's when you can really capitalize.
What's making people most afraid?
Probably all of it, economic conditions, what's happening with tariffs, where the country's heading, what will happen with vet med if people continue to dump as much money into their animals as they were pre-pandemic, because some of those numbers have come down.
How far down? Because wouldn't you just say it's a pendulum and everything reverts back to the norm?
I would say that, yes. I think that there are a lot of people who are concerned that it's just heading one direction. Those are the ones who aren't moving.
Those aren't moving.
Correct.
But you just said that there's some people that shouldn't be moving, right?
Sure.
But wouldn't that be very hard to tell a business owner that is in business to grow and try for more, that it is the right time to actually
Yeah.
flatline a little bit?
Actually, Jared, I think that's the great part of your world and mine.
Why is that?
I think as advisors, we can take a look at the financials and decide whether they're in a position to be making those moves.
Well, I know how I analyze a financial. Is that different than how you analyze a
I'm
financial?
not 100% sure how you analyze financials, so it's just a challenging
Walk
question to
me through your lens. What are you looking for?
Some of like your favorite words:
Got a lot of them.
depreciation, interest, add backs.
How would that impact?
Gosh,
how
you
would
like
that-
add backs.
How would that impact? How would that impact the lending perspective?
Cash flow. It's all about cash flow. Do you care about cash flow in your world?
It's critical.
Yeah, same. So if the cash flow can support it and there is an added demand or need, then it may be the time to grow. I'm also a believer in veterinarians owning their real estate if possible.
And what would make it not possible, short of them not being able to secure the piece of property from the current owner?
That rental rates market, what's available, their ability to take on more debt, their willingness to take on more debt, our approvals also factors in.
How often is it that you find the startup unable to acquire the real estate at the same time, and what happens in that case?
Not everyone should own the real estate from day one. When I say I prefer them to own the real estate a little bit further,
I'm going to give you a different answer from a tax perspective.
you think they should own from day one?
100% should.
That's why Creative Peak and Live Oak should work together a lot.
Well, we'll see about that.
He's a tough lineup. So a lot of veterinarians come out of vet school with some pretty big student loan debt.
Sure.
And they're going to take on a lot of debt to even lease a space. Average leasehold startup 2,500 square feet through the exam room GP is, $750 to $950 loan size. $750,000 to $950 as a loan size. Depending on what market you're in, you might be another million or more into a real estate purchase. So for some, it sounds insurmountable to take on that much more debt. And for others, whether they can qualify, whether they can get that type of loan is another piece to that. And then just availability within the market that they want to be in. So if it's somewhere where they really want to be and they can't change their mind on that, it might be availability that takes it out.
So if I'm in the market and I really want it, and I have a ton of student loans, like you said, are you hurting my borrowing ability because of my student loans?
Nope. We're used to seeing pretty large loans, but it will then come into play of what other debt is on the table. So we're looking at full relationship for your household. So student loan debt, home mortgage, car payments, credit cards. So if you're fiscally responsible in other ways and you don't have a ton of obligations outside of student loan debt and you have this massive student loan debt obligation, it's possible it can still work.
How critical is it for, if you can't get it accomplished yourself, to partner with someone to get the financing you need?
Do you mean bring in a second vet or do you mean bring in a non-vet?
Both. Let's start with the partner.
I might be in the minority on this, but I don't love partnerships to start.
Why is that?
I just think That's usually because one person is a little bit nervous about their abilities, a little afraid of what they can't take on, when truly a veterinarian can run every piece of it themselves from day one with the right team around them. And you're diluting profitability and your margins, and truly difficult to get out of that partnership if there are any issues down the line. And a lot of times people are doing that on the front end more fear-based than any other reason.
I don't.
Can I ask you a question?
Please.
Why are you for owning the real estate from day one?
Well, I think it's one of the most tax efficient vehicles you can have. The depreciation alone sets you up really nicely for the first 3 to 5 years. If I'm putting money into a property, I want to partake in that appreciation.
Okay.
Let's go back to what you said, though, because
This is helpful, though.
no, it is an interesting topic on the partners and partnerships, because I do tend to view that most times it's better to attack it alone to start.
Yes.
Not always.
Fair.
So what would make partnership to make sure you avoid some of those issues?
I think the ones that I have seen be insanely successful is they have had some sort of a partnership predating this. So even honestly, some of the best ones I've seen have been on sports teams together and then went and did it, or they were involved in some organization together, or they were the only two associates at a practice together, absentee owner. So they were really running it between the two of them. Outside of that, I think it's pretty challenging because you don't know exactly what you're stepping into with a partner. And a lot of times one partner is willing to hustle and work significantly harder than the other, and you're still splitting the profitability 50-50, and it just becomes wildly problematic. And usually one partner is pretty frustrated down the line, and then getting the buyout becomes super challenging.
Well, it doesn't have to be 50-50. What, from a lender's perspective, is it 10%, 20% when that other individual starts to matter?
If they are 20% or more owner, that's in the eyes of the SBA. So SBA loans here, 20% or more, they have to be on the loan. But once they hit that point, the 20, even if it's an 80-20 split, they're truly in the deal. If it's $1 million loan, if you were the 20%, because of the two of us, I would have the 80.
Gotcha. That's a bad partnership.
You're saying if this wasn't the 50-50
No, I'm
split,
just saying. Yeah.
I am just as responsible for the debt as you are, and vice versa. So it's not like you have 20% of the debt and I carry 80% of it. So that's where it becomes challenging, because even if you skew the percentages, really your names are on the loan equally. Same thing with collateral. If both of our homes are on and you have $1 million of collateral in your home and I have 100,000 of collateral in my home, yours might be more valuable to the lender. You have to put yours up and you're the 20% owner. That's challenging for you and I to have that conversation. That's where partnerships become a little
So forget
difficult.
the partner then. How often, or do you require that spouses, parents get involved and put their name on the documents?
So
Because I would think you would want to avoid that at all costs.
spouses and parents?
Correct.
Are you saying you'd want to avoid, you're saying the vet would want to avoid that?
Yes.
So SBA rules, if you are married, we have to look at full household assets and debt. So the spouse is signing all forms on the front end application, personal financial statement. You are showing all of the debt and all the assets for both people. But if the vet can qualify on their own, the vet's spouse is not on the loan.
Not on the guarantee.
Both.
Either.
Yes. We don't usually have a spouse come in to sweeten the deal to make it work. That's more of a conventional lender deal. They tend to go that route. I agree with you. I don't want the spouse on. I don't want parents involved, anyone else, if it's possible for the vet to qualify on their own.
So help me, because you mentioned conventional deal. Real basic. Conventional versus SBA. What are the biggest differences? Because I feel like you can read a lot and see a lot about the SBA, avoiding the SBA, but clearly where we are, it certainly works.
Right.
There's a purpose for it. So what's the major differences? What's the major benefits going with the SBA route?
So I don't think SBA loans are for everybody, nor do we pitch it, nor are we trying to get every deal, nor do we say yes to everything. There's very specific times when an SBA loan is wildly advantageous, and when it is, that is what I would believe that should be using. Biggest difference between the two is that an SBA loan is a government-backed loan. So it's $1 million loan, and you were looking at two options. If you were doing it through Bank of America, Practice Solutions, and us, and you're the vet, you get into it, and a year down the line, you suck. Things are going really bad. You're defaulting on the loan. You're about to go BK. You're walking from the deal.
Sure.
So you still owe right around $1 million, right? Because Bank of America has to collect. They're on the hook for the full $1 million.
Sure.
So the bank is taking on the risk of $1 million loan. Here, if that same whole scenario came into play, and let's say we did everything right, crossed all T's, dotted all I's for an SBA loan, we've done everything right for your loan.
Sure.
$1 million is owed. We're getting $750,000 from the government.
Okay.
So really our loss is $250,000, not $750, if we can't liquidate anything.
Perfect.
So we can take on more risk than a conventional lender.
But you're explaining all the benefits for you, the bank, that you're going to get paid on the transaction no matter what. I'm talking about for the practice owner. Where's my benefit of speaking to you?
Do you want to talk about a startup or an established practice owner? Because I think there's two different answers. So currently, if you're a startup and you wanted to own the real estate and start a practice, average size probably $1.5 million to $1.8 million. That's all in. Working capital, equipment, build out, real estate, closing costs, soft costs, blah 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 blah.
All of it.
Okay, 1.5 to 1.8. If you went to a vet specific conventional lender, they will say no to the deal.
Why is
that?
that?
Is taking on way too much debt. They're doing it on shorter terms. They can't take on that much risk. They don't view that as a viable transaction. We would say we can either partner, so a conventional lender can come in and do interior build out equipment working capital on one loan. We just do the real estate, or we'll do the whole thing. If we're doing the whole thing, it's on 25 years.
And what would
stretch out the cash flow?
The conventional cash flow look like? What is that? What's the terms?
20 years on real estate, 10 to 15, depending on the lender, on the rest of it.
But if I'm taking out a 25-year term for my practice startup in real estate, there's no financial analysis or budget I'm going to show that would want me to have that long of a repayment period.
You don't have to. It's only a 3-year prepayment penalty.
Is that prepayment penalty? What does that mean?
It would be the penalty to pay off the loan early.
In principal
full.
Early, or to go out
Pay it
and
off in
seek
full.
another lender?
After the 3rd year, you can do anything you want.
Really?
You could pay off in full. You could refi with another lender. You could start chipping away at it faster. Technically, you can chip away at it from day one. So you can take off 25% of the principal balance in the first 3 years with no penalty.
Okay.
So it's a 25-year amortization so that you can stretch out the cash flow and do some pretty interesting things with your practice, but you can pay it off early if you want to. So it's really like the best of both worlds.
That seems pretty clear that if I am a startup that wants it all, the equipment, working capital is just the money's in my bank day one.
Yep. For yourself, for your staff, for utilities, for getting the thing going, marketing.
What's like the average amount that we should have in working capital?
Conventional lenders will tell you around 75 to 100,000. Ours is a little bit more, we get a little bit more specific because it's a difference if it's a vet dentist or ophthalmologist or straight GP, or there's urgent care of what the cash burn is going to be. So, our working capital can range from 100,000 to 300,000 probably on average for a startup.
All right. So clearly then is a startup, bigger loan size, wanting real estate, wanting it all. Clear benefits with the SBA is I'm going to get a longer term. I'm going to actually get a deeper conversation because a conventional lender might just say, can't do it.
Right.
What about if...
Or a leasehold. So let's just say you're in a very expensive area. Like, where are you?
New Hampshire. Right.
Close enough to Boston, right?
Close enough, yeah.
Okay, so rent rates are really high there, right?
Range
50 plus a square foot is my guess.
Sure.
So if you wanted to have a larger practice, if you were starting at, 3,000 square feet, 5,000 square feet, whatever, the build out cost of that is pretty expensive. And then your lease is pretty expensive also. So a conventional lender isn't going to love it. You're going to kind of go beyond that $900,000 mark. That's when the SBA can come into play again, because we can take on more risk. We can do larger loans. As long as it works, you got to complete business plan, projections. We're looking at projections. We're probably talking to someone like you to understand if you think they're realistic as well, if they have a good CPA. Because we don't want to over leverage them on debt, but that's another way where SBA can make sense. Larger loans for startup.
Help me with the projections. Because projections to me are a piece of paper that you hope to be realistic, but I think if I looked at 9 out of 10 projections that have completed 12 months from the completion date, they look wildly different.
So we do, it's an SBA rule. So a borrower has to complete 3 years, month by month projections. But we're not using their projections. We'll have We are, but I mean, you can have a startup that says they're going to do 4 million in year one, and now that $2 million loan is really easy to justify. But if they've been producing, they've only been doing 500,000 as an associate, then you know they're not hitting those numbers. You know it doesn't suffice in that area. We look into the demographics of the location, what type of services they're considering, fee schedule, all that stuff, and then we're doing lender adjusted projections. So we're not going off of what the borrower says. We're looking at what they have submitted, analyzing, and then doing our own adjusted projections for production and bottom line. And that's what we're making our decision off of. And then we go back and track. So we've got about 1,000 vets on our portfolio, and we are constantly tracking those metrics and see if, to your point, when we go back a couple years later, are they actually hitting those numbers? And if they're not, and we're way off, then we are further adjusting our projections and what we're using for ongoing basis for veterinarians, new ones coming in.
So why not just take that process and do it directly with the practice owner day one? Why have them submit a projection that you're going to then
SBA, the SBA one, it's an SBA requirement. There's no get around to that. And it has to be borrower completed. They are signing off that those are their numbers. Secondarily, I think it's really important that they're actually thinking about it and that they've put some thought and manpower behind the numbers that they're submitting and really try to bring them to a place of reality. Either way, some of them come in, I think vets tend to be a little bit more conservative. So sometimes what they come back with, we're saying, actually, look, you were a $1.5 million producer. You think you're going to do 400,000 in year one, and you're staying in the same ish area, and you know what your plan is. We're adjusting either way, but we want to be able to have those very open conversations. And honestly, I believe they should be doing some work on their end and really understand the business that they're trying to get into.
Gotcha. That covers the startup.
Yeah.
Now I'm in my practice, which is a leasehold.
Yep.
I've outgrown it. I want to buy a building. How do you analyze that?
So now you got tax returns, right? So now you're actually analyzing what the vet's been doing year over year. But what we allow for on expansions is also projections again. So we know when a vet is in a space expanding, even if they are relocating directly next door, it's 20% growth year over year on our portfolio. So everything that we analyze is 20% year over year on average. So we can say the cash flow of current tax returns supports X dollar amount, but can you stretch a little bit further than that? You're going from 4 ops or 4 exam rooms today, and you're going to 6 exam rooms down the line, or you've got 1 vet in today and the plan is to bring in 3, and you've got a specialist in there as well. They're already signed up, whatever.
Sure.
We can look at projections and say, okay, this vet can actually stand to take on a little bit more debt than what it looks like historically to get to where they want to go. That is a huge advantage of SBA financing. When you're looking at a conventional lender that is strictly off of historical tax returns and what the debt can support today. Also, again, real estate involved, 25-year amortization, established practice owner, which is 1 year in, 100% financing. So you don't necessarily have to put the skin in the game to be able to grow.
What if they have pre-existing debt? What do you do there? What do you do with, I'll let you answer that because you seem like you have an answer.
I think that's another nice part about SBA financing.
With
so
existing
let's
lender.
say you've got a lender, let's say it was Provide, came in on the front end, and you got in at the great time when rates were like 3.25%, 4.25%, 5.25%, whatever. And you still have 600,000 in debt. You don't want to touch that if you don't have to. An SBA lender like us can come in behind that lender. So potentially we take a junior lien behind them. And if, this is like relocation, ground up construction type deal, now we're taking a first on the real estate. We value the real estate as the biggest piece of collateral. Those guys typically see the practice and the practice itself, its assets, as the largest asset of the business. So we have differing views on what's most important. So it allows us to get pretty creative with financing.
Speaking of most important, I would think that you go and do that second location or second building. Working capital is most important.
Being properly capitalized to do the project, I think, is most important. I think what happens is that you're looking at the vet thinks it's $1.5 million ground up construction project, and it's actually $3 million. Now it's more about having dollars to do that than it is capital, working capital.
Well, 2 questions then for that, because how involved are you getting to ensure that the budgets that's being put in front of the doctor is?
We have a very large, robust construction team, and we have all the data of every project we've ever done. So we are constantly evaluating what the vet is telling us, who they're using, whether it's a qualified GC, if it's someone that's done vet work before, vet, dental, it's about the same price per square foot. So we're really trying to be realistic. We're talking to the real estate agents in the area, so we have a really good feel, especially when they're vet specific, of what the real estate is actually going to go for, what the plan is, what the GC is coming back with, down to stuff within the city. Like places in Colorado have tap fees of 120 grand plus. So if that's something you're not budgeting in there from the beginning, that can screw up budget very quickly. We are wildly involved, and we try to stretch as much as possible. Borrower doesn't have to take all of the debt that we put out there, the number we put on the front end, but we wanted to actually look at worst case scenario and then back it in.
What percentage, because you clearly have the numbers, what percentage or what dollar amount usually goes over budget?
So if it's $1 million construction project, we say there has to be 10% sitting in contingency for overages, change orders from the borrower or the GC, and that's sitting there for the project. So now it's actually 1.1 is what's there.
Sure.
So to answer your question, the average is about 6% of contingency is used.
Then what happens to that extra 4%?
Either moving down to equipment budget if needed, which is typically the area where is under budgeted the most. And that's more a matter of, no matter what we say, advisors say, you know, they're working with Patterson or whomever else is quoting them on the front end, the further they get into this thing, the more that they need or want for the facility. So it either drops to equipment budget, or more goes to working capital, or overall loan amount is dropped before they go into repayment.
And why don't you feel like the working capital portion of that budget is the most critical? Because if you're taking a 2-doctor practice that's building to a 4-doctor, their payroll costs are going through the roof. Everything about that is going higher, but the revenues haven't caught up yet.
Because you didn't talk through the balance sheet. And your scenario, I have no idea what they have on the balance sheet. So what if they're sitting on a bunch of cash?
Do you require?
Do I want? No.
All right,
we don't have a liquidity requirement.
A very lean balance sheet. 2 months of working capital.
Well,
2 months.
then we're doing the analysis of it's going to be whatever it is, 9 months, 18 months ramp up, depending on how long the construction project's going to take, and then how long we feel from there, along with the guidance from the vet and their whoever's on their support team of saying this is going to take us 6 months after we open the doors of ramp up. We are doing a very specific model to understand how much working capital they need. Hence why in some of these scenarios it's 300 grand or more. But we're not trying to over leverage the vet either. They shouldn't take on more debt than they have to. So if they're sitting on cash and they don't want as much as a reserve, then we feel good that there are funds there if needed. We are not stingy with working capital though either. The whole point is to make sure that they can get through this ramp up period successfully and that they actually start in the practice day one set up to succeed. There's an interest only period.
Right.
So if it's a ground up construction project, it's typically 12 to 18 months, sometimes 24 months of interest only. But that's also could be a line item on the loan. It's called interest reserve. So essentially the loan is paying for itself for the first 18 months. So they aren't making their lease payment at their current location and this mortgage payment for a practice that they aren't in and growing. So there's these little metrics in there too.
It's accruing. It's that they're going to have to pay that
for sure. That's why a lovely discussion with a CPA like yourself to understand whether you're okay with that. It's not a requirement.
Sure.
However, you may look at this and say, I don't want my vet taking on the lease payment that they're in today and their interest payment during this time. It's going to be too much of a stretch on their cash flow. A lot of times you guys are making the call on that.
And is it 12 to 24 months of interest only from the date that they sign the commitment letter, the date of the first draw, the date that the project is
close, the day they close on either the real estate purchase or land usually, or in a leasehold scenario, if it's one of the larger ones, then it's a little bit more fluid, but usually when permits are ready to go and they're basically ready to start construction.
So that interest only period truly just gets me through the construction phase then?
Ideally, it gets you through the construction phase and however much of a ramp up the vet and we have decided they need. So you might end up with, it might be a 12-month construction project and we do 18 months of interest only. So now you're in it for 6 months. But again, there's also working capital on the loan. So if everyone decides collectively that we really only need 12 months of interest only payments baked into the loan, but we're going to increase working capital, that can happen too. It's just semantics.
With the SBA, do they have specific ability to defer payments longer than the 12 to 24 month stretch?
For the interest only part of it?
Please, yeah.
The technical answer is 24 months is supposed to be the cap on interest only. The also very technical answer is that you have 4 years to complete the project from the day that you close. That is SBA rules. If it's going beyond the 24 months, we've got to figure out collectively. We have a less than 0.5% default rate on the portfolio. So we're really good at going through this and figuring out how we don't put the borrower in a position that they're coming out of construction. Construction took a really long time and now they're trying to make these payments and can't. We'll figure out a way to make it work. A lot of times it might be increases on the loan too. So it might end up on the back end of this thing. We've got to add another 100,000 in working capital or whatever.
Sure.
So it might not come in the
To make
form.
that late change.
Yeah. It might not come in the form of additional interest-only payments. It might just be more working capital. Again, not trying to overcapitalize the doc. So
Sure.
that comes further down the line.
As we wrap up here, what's too soon to come to you, go to Live Oak and say, hey, I got an idea, I got a concept, I got
Never
targeted location.
Never too early.
Even if
we can be fully educational and nothing beyond that. So if a doc just said, I got 2 years left to go in my non-compete. I'm just trying to figure out what this looks like down the line. Awesome. Let's have the conversation. Let's get them in a place where their personal credit is getting better or improved if needed. Every freaking vet in the country appears to have a Kohl's card that they took out at some point with late pays. Start to get them in a position to be able to do this. At least set realistic expectations that a lot of times they'll come to us and be like, okay, I want to do this ground up construction project, 3,000 square feet, blah, 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 blah. They have no idea that one, what the land cost is, and two, the price per square foot.
So how do you
They
handle
look at it as residential. They're going to
Wouldn't that be
say,
too many variables for you to make even a informed decision, or you're
I can say what this looks like today
Gotcha.
and at least start to get their minds wrapped around what this is going to be. And we can keep following up every 6 months. We can say, okay, now the tariffs went into play and lumber cost and steel prices are way up. So what we were talking about for construction before, you might want to tack on another 10% to that. You can keep going with it. It can build over time, but we'd rather be educational on the front end. Or if they look at those numbers and they're like, this is way too much debt, I'm not comfortable doing this, even if you guys said yes, then they should start looking into leasehold options and we get them directed to the right place. They should be going with a conventional lender, walk through the process, get them set up.
Sure. Final question, because I feel like a lot of this ultimately, whether right or wrong, comes down to rates. And
Oh, I love rates.
some are higher, some are lower.
Yes.
Is there a differentiator where, yes, rates are important, but they can't be the end all be all, like post-closing,
Yeah.
doors opening? What is your role with that practice owner, if at any?
But specifically to rate?
No, just in general, because if I'm comparing bank A to bank B and there's a differing of rates, do I 100% always go with the lower rate, or is there other variables that make that decision?
Yeah, I would hope every vet, regardless of who they're working with, understands that there are multiple factors beyond rate that matter a lot.
Well, share that with me, because I think a lot of times you get clouded by, no, this is lower, let's go with this bank.
Yeah, first and foremost, are you going to be properly capitalized for the project? So if you get a 2% interest rate fixed, no matter how low it is, it doesn't really matter if you don't have enough capital to do the project.
Right.
So the actual loan amount matters. Do they know what they're doing? If there are increases throughout a project, and COVID was a great example. There were vets who were partway through a project, COVID hits, now their projects are getting massively extended and everything went through the roof. Cost of everything. I mean, we were doing massive increases. If your bank can't do that, that matters. Prepayment penalty. So is the plan to get out of this debt pretty quickly? What does the prepayment penalty look like? What else are you having to get? Do you have a full relationship with the bank? If it's a full relationship required, then what other fees are in there? Is it
What's a full relationship?
DDA, merchant services?
So, like, is it completely exclusive, or is
A lot of banks are wrapping it together. So if you're going to do this loan for you, they are also requiring full relationship, which is great and may make sense, but you need to look into full package then, that it's not just the rate on the loan.
Mhm.
And what you think is going to happen. I mean, no one has a crystal ball, but where you think rates are going and whether it makes sense to have something fixed or whether it makes sense to have something variable, that could determine what type of loan makes the most sense for you.
how?
Also, whether you're injecting cash. So if someone's giving you 100% financing and the other one is giving you a lower interest rate, but you're putting 400,000 of cash in to make this thing work,
Right.
it depends on what the value of money is, where you had it sitting before, what you could earn on that money that you have sitting in some interest-bearing account. How'd we do?
I think you did pretty well. I think you changed the
I
game.
said we.
I think I might have to make all podcasts in person, because I think it's just
It
what else
was
up to it. I appreciate it. I appreciate all the time you've given me.